All right, so we're going to talk about the statement of cash flows. Um, First video is about, and there are really three parts of this. The first part is background and concepts video. The second one is a little bit of um, a case with some facts that I'll provide in part two, and we'll discuss all the way through investing and financing activities. Part three is where we get into the operating activities for the indirect method. We'll complete the indirect method uh, cash flow statement, and we'll discuss what we can learn from the cash flow statement. Part four is the operating activities for the direct method. So let's get started with the background and concepts. Um, The aim of this is to understand how we use the cash flow statement, to know the classifications on the cash flow statement, to distinguish between the direct and indirect approaches of the cash flow statement, and understand the concept behind using the balance sheet to construct the cash flow statement. And then we learn the steps to constructing the cash flow statement. So those are our aims, and that's where we're headed next. The statement of cash flows is a supplementary statement. It was formed and required only in 1985, which, while it was quite a while ago, it is young compared to the balance sheet, which came about in the late 1800s and before, and all the way back to Pacioli in 1492, and then the income statement, which became used in the United States in the 1930s, 20s and 30s, but mostly in the 30s, and then the statement of cash flows in 1985, FASB required it. It's a supplementary statement that primarily you can get the information from the other financial statements, the balance sheet primarily, and the income statement. The objective is to explain the change in cash. So if you want a bottom line, the bottom line is the change in cash for the year. And we explain that in terms of changes in cash that come from operating activities, from investing activities, and from financing activities. This categorization is kind of arbitrary. We think of financing sources as coming from debt and from equity, stockholders. But for some reason, at least at this point, interest paid is an operating activity, while dividends paid is a financing activity. So, how is it used? It helps us evaluate the liquidity of the company, that is, its ability to pay its bills as they fall due. A company that has substantial positive operating cash flows, especially relative to net income, we call a cash cow. You don't need to keep as much cash on hand for a cash cow because they're constantly generating cash. Other companies burn cash, especially like a high-tech company or a pharmaceutical company that hasn't gotten through the FDA clearance process. Those companies need to have a lot of cash because they're just burning it in order to create the product that they're trying to come up with. It helps us assess the earnings quality. Companies with earnings that are supported with lots of cash have high quality earnings, and companies with lots of earnings but very little cash to support it, we consider that questionable earnings in terms of the quality of those earnings. Helps us learn things about what the company invested in and investments that it sold, how it raised its capital, all of those things that you cannot see as clearly on the income statement and balance sheet. And then it helps us value the firm. As you'll recall, the value of the firm is the present value of the future dividends of the firm. That's the dividend discount model, or the dividend or the discounted cash flow model is more directly related to this, and that is the present value of the future cash flows of the firm is a measure of the value of the firm and conceptually correct. The sections of the statement of cash flows: operating activities, these are cash from operations, cash received from customers minus cash paid to pay for suppliers, to pay employees, those kinds of things. Investing activities, these are purchases and sales of long-term assets and marketable securities, and we include marketable securities even though they're a current asset. And financing activities, the issuance and retirement of debt and stockholders' equity. This includes dividends paid, treasury stock purchases, and sales financing activities. Here's our accounting equation: assets equals liabilities plus stockholders' equity. And what we're going to do now is we're going to break this down into current assets and long-term assets. And current asset is equal to current liabilities and long-term liabilities. So all we're doing is breaking up assets into current and long-term, and liabilities in current and long-term. The accounting equation remains intact. And then if we parse out cash from the other current assets and leave everything else the same, it looks like this. And then if we subtract the other current assets and subtract that from both sides, it means that removes it from the left-hand side, and it moves over to the right side as a negative. And we subtract long-term assets on the left side, that makes it 0, and you put it on the right-hand side. And now we have a restated balance sheet or asset accounting equation. And finally, if we take that version of the accounting equation, then we can put just changes, and that means that the change in cash is equal to effectively the change in current liabilities minus the change in other current assets. Those first two are considered the operating activities generally, and then plus the change in long-term liabilities and the change in stockholders' equity. I'll group those together in just a moment. They are considered, generally speaking, the financing activities, and minus the long-term assets, which is the investing activities. There's some exceptions to that. And in other words, the change in cash is equal to the net change in all other balance sheet accounts. And we can group them, like I said just now, the first two being the working capital or the operating activities, financing activities, and investing activities. Operating, financing, and investing. There's two acceptable ways to report cash from operations. One is the direct method, and it just basically lists the cash inflows minus the cash outflows. Easy to read. Unfortunately, it's not used by many American companies. You see it outside the United States, especially in Australia, but American companies still like the indirect method, where we start with net income and add back or undo the effects of non-cash revenue and expense items. And we're going to focus on the indirect method first because it's the one most used in the United States. Now we're going to take you through some steps that when you get done, you will have prepared your cash flow statement. The first step is to write out a template with the statement header and categories. This becomes like a picture frame that you start to fill in the picture. And then the second step is the very top line, which is the bottom line off of the income statement. I consider it the starting place for the cash flow statement is the net income from the income statement. Number 3 says compute the change in cash. And this is the bottom line, really. It's not truly the bottom line because typically there's a little reconciliation at the bottom, but this is the target. This is what we're trying to explain, the change in cash, as I discussed in the algebra, where we put the change in cash on the left-hand side of the accounting equation. Number 4, we want to compute the changes in the balance sheet accounts. All of the balance sheet accounts that are listed there in the balance sheet, we're going to compute changes for that. That is, take the last year, the most recent year, minus the beginning year, and that becomes the change. We're going to classify, number 5 is to classify all of those changes as O for operating, I for investing, or F for financing. So just put a little O, I, or F. Sometimes it can be 2 different categories. So maybe an O and an F, or an O and an I. We'll talk about that. Number 6 says explain changes in cash by analyzing the long-term accounts. That is, the long-term in assets are typically your investing activities, and the long-term liabilities and stockholders' equity are typically your financing activities. Number 7, we want to compute the cash from operations, and this is the hard part. And so we want to save that hard part till step number 7. And we're going to start with the indirect, because the indirect is the one most commonly used by American companies. And number 8, we're going to compute the section totals and add them up and see if it works. Theoretically, according to that algebra that I just showed you, if you explained all of the changes in all of the balance sheet accounts, then you have explained the change in cash. And number 9, we're going to report the non-cash investing and financing activities. An example here is if you buy a building by issuing the seller a note, but there's no cash involved, then you would report that as purchased a building by issuing a note payable or a mortgage payable. That is a non-cash investing and financing activity that needs to be reported. To summarize, the direct form of the operating activity section looks something like this. Just cash inflows, and they typically are collections from customers, minus cash outflows, which are typically things like payments to suppliers and payments to employees, and the net change in cash. It's a very straightforward and simple approach. Unfortunately, many American companies do not report it. Instead, they report the indirect form, where we start with net income. And as you recall, net income is revenues minus expenses. And revenues are recognized when earned, not when collected, and expenses when used up and not when paid. And so in order to convert that to a cash flow, we have to undo all of the things that affect net income but do not affect cash flows. So we make adjustments for things like depreciation expense. We're going to add that back. It's an expense that reduced net income but did not cost us any cash. It was just a debit to depreciation expense and a credit to accumulated depreciation. And as you know, an increase in accounts receivable, a debit to accounts receivable and a credit to sales, that increases revenue, but it does not increase cash. So we subtract that increase in accounts receivable that had a positive effect on net income but didn't affect our cash flow. And an increase in accounts payable is used typically to pay for operating expenses. And so we have a debit to operating expenses and a credit to accounts payable. That decreases net income for operating expenses, but it did not decrease our cash. And so we need to add that back. In the next video, part 2, We're going to take you through the investing and financing activities and in an example. The example is Carrera Corporation's cash flow statement. But we're going to start with the investing and financing activities in part 2. In part 3, we'll do the operating activities for an indirect cash flow statement. And in part 4, we'll do the direct method of the direct form of the operating activities.